Hi everyone, welcome back to this week's Technical Insights. In the first 3 weeks of June, global markets had a really strong run coming off soft economic data like the PPI and the CPI data. But last week, we saw some signs of an overextended market. For now, it is still unclear whether the AI fueled rally has reached its limits. Nvidia, which is large enough to sway the market, is showing signs that its upward momentum may be slowing. But the decline in tech names like Apple and Microsoft does not mean that markets are crashing right now or having massive pullbacks. It is more of a rebalancing because the valuation of those tech companies have gotten so far ahead from the average stock that you probably would see some broadening. Hence, the Dow still managed to edge up last Friday despite the S&P 500 and the Nasdaq finishing lower. Before we go further, let's have a quick look at how global markets have ended last Friday. Our Singapore Straits Times Index closed higher on Friday, up 6 points or 0.18%. In Asia, Hong Kong Hang Seng Index fell 306 points or 1.67%. Japan Nikkei 225 lost 36 points or 0.09%. In the US, the Dow Jones Index edged up 15 points or 0.04%. The S&P 500 ticked lower by 8 points or 0.16%. The Nasdaq Composite Index dipped by 32 points or 0.18%. Technology stocks continue to be in the spotlight as Nvidia shares declined 3.2% for a second consecutive session on Friday. On Thursday, the stock hit an all-time high before crashing more than 3.5% lower. Nonetheless, the chipmaker is still up 155% year-to-date and is briefly beat Microsoft as the most valuable public company last Tuesday. For the week, the Dow Jones Index rose 561 points or 1.45% to finish at 39,150 points for its best weekly performance since the month of May. The S&P 500 gained 33 points or 0.61% for the period to finish at 5,464 points after registering an intraday record high of 5,505 points on Tuesday. Tech-heavy Nasdaq Composite Index finished flat to close at 17,689 points. In Asia, Hong Kong Hang Seng Index gained 86 points or 0.48% on the week to close at 18,028 points. The Hang Seng Tech Index, however, dropped 6 points or 0.17% for the period to close at 3,701 points. Chinese markets were hit by a weakened Chinese yuan, which hit a fresh 7-month low as trade tension escalated after the reports that Canada planned additional tariffs on Chinese-made electric vehicles following similar actions taken by the US and the European Union. Week to date, our STI index gained 8 points or 0.26% to finish at 3,306 points. The biggest gainer on Friday was DFI Retail Group, which climbed 2.67% or US 5 cents to US $1.92. Offshore and marine company Seatrium saw the biggest drop on the index as their shares fell 1.94% or 3 Singapore cents to $1.52. So let's move to the charts and analyze how the stocks will perform in the next few weeks. First, let's have a look at DFI Retail Group. We covered DFI Retail Group on the 27th of May video. We noted that DFI Retail Group share price is still in a long-term downtrend since the February of last year. Year to date, the share price was also unable to hit a new higher high despite huge gains that we saw on 3rd of June at 7% and last Friday 2.67% gain. This likely means that the downtrend is still very much intact right now, and we shall reiterate the previous strategy where the preferred direction would still be to continue to short DFI Retail Group share price once it hits a prominent resistance level, like the upper bound of the Bollinger Band, now at $1.96, or the 100 days moving average, now at $1.98. Indicator-wise, the MACD indicator is just a tad above the zero-based line right now. The MACD line and the signal line suggest that momentum is quite neutral right now, as both lines seem to be moving in a horizontal direction. The latest RSI reading is 52 points, 2 points above the 50-point neutral mark, and also 2 points above the 40 days RSI moving average. This reading suggests that the momentum is still very weak in the DFI Retail Group share price now. So we should continue to look for prominent resistance level like the upper bound of the Bollinger Band over here, which is at $1.96, or the 100 days moving average, which is the blue line over here at $1.98 for a short position towards the year-to-date low again on 19th of April at $1.75. Next, let's take a look at Seatrium. Similar to DFI, Seatrium is also in a long-term downtrend since the September of last year. Their share price recently found a new low on the 19th of June at $1.46, which is also the year-to-date low right now. Year-to-date high was seen in the January period of this year at $2.40, and the share price has continued to form lower highs in the first 6 months of this year. This suggests that the downtrend is likely going to continue forward, at least in the next few weeks. Key resistance level to look out for will be the Bollinger Band basis at $1.69, with the 50 days moving average, which is the amber line that you see here close by at $1.70. Above this, the next resistance level will be the 100 days moving average, which is the blue line that you see here at $1.75. Indicator-wise, the MACD indicator is showing a negative reading right now. Hence, there's still negative momentum right now in Seatrium share price, and the share price is likely to decline in the near term. The latest RSI reading is at 37, which is below the 50-point neutral mark, and below the 14 days RSI moving average at 45 as well. So momentum is still very weak in Seatrium share price, and it hasn't hit an oversold level. So with both indicators, the RSI and the MACD indicator, signaling that momentum is still weak and the share price of Seatrium is likely to trend lower, key resistance level like the Bollinger Band basis at $1.69 and the amber line, which is the 50-day moving average at $1.70, will be ideal levels to take a short position, targeting the year-to-date low at $1.46. And these are the updates that I have for you this week. If you do find this information useful, do remember to like, share, and subscribe to stay updated with the latest market developments. And I'll see you again next week in the next Technical Insights.